Qualifying for a home equity line of credit or a HELOC is very different than qualifying for a traditional mortgage. Yes, there are some similar overlaps or qualification criteria, but what they look for and what are some of the trigger points in getting a loan approved versus declined are a little bit different. And that's what we're going to get into today on this topic here for the Mortgage Reports. My name is Arjun Dingra. I'm a regular contributor here, a content creator, and a certified mortgage advisor in the San Francisco Bay Area. I love being part of this platform because it truly empowers buyers, sellers, or just anyone seeking real estate and financial literacy. We appreciate you guys tuning into it, and let's get into this topic. Okay, so people will assume falsely and incorrectly that just because they own a home, I can just access my equity at any time. But that's not the truth. You have to qualify for and get something established, which is where the HELOC comes into play. Now, the first criteria or requirement for a home equity line of credit is going to be the equity, or how we refer to it as LTV, loan to value. Now, this is the spread between what the home is worth and how much you actually owe. That spread is your equity. Now, most lenders want or are looking for you to have more than 20 to 25% equity in a home before allowing you to take out a small portion of that. And they typically won't allow you to go above 80 or 85%. Some lenders will even go up to 90 on special exception, but they don't want your equity to be completely evaporated or all taken out in the form of new debt. Because if there's a correction in the market or something were to pull back, or if the lender had to foreclose on you for any terrible reason, there needs to be some value in there for someone to resell this property. So just remember, there's going to be that spread and then there will be a limit. For example, if you have $1 million home and you have a $600,000 mortgage on it, meaning you have $400,000 in equity, you can't get a HELOC for $400,000. Next is the credit score, and this one matters. The FICO tier will have a big impact on ultimately how your HELOC is going to be qualified for and the final interest rate that you get. Now, if you watched some previous content around topics like this here on the Mortgage Reports, I explained in another video that a HELOC rate is calculated by taking the prime lending rate, which is 6.75%, and adding a margin to it. Now, this margin is going to have a number of factors that will affect it and either make it larger or smaller. And if your credit score is not as strong, this is going to have more meat in it. So there's risk-based pricing that comes into this, as well as other factors that will affect that margin. The loan to value will affect it, and even the property type. So bear that in mind when you're starting to put together some analysis here for this product. The next requirement or major criteria is your income, or what we refer to as DTI, debt to income ratio. Now, if you're a W-2 borrower, this is a lot more straightforward and easy. If you're self-employed, then there's a little bit more scrutiny and looking under the microscope that's going to take place here when it comes to your financials, your bank statements, and how income comes in, how it goes out, what kind of expenses you have. But your overall debt implications are going to impact your approval, because a home equity line of credit lender is going to want to see a safe range, sometimes in the 42 to 45% or under, that your overall monthly debts are not exceeding when compared to your overall monthly income. Now, keep in mind that you can get a favorable nod here if you are consolidating debt. So for example, if you have a mortgage and you have a lot of debt, and that's the reason why you're getting the HELOC, and those debt payments are making your current debt to income ratio very high, and this new HELOC is actually going to bring it down, you can get qualified based on what the outcome debt to income ratio is going to be. So keep that in mind. Okay, and lastly, the property type is going to matter. First, whether this is a primary residence, which gives you far more favorable HELOC terms, or if it's a rental. Now, if it's a rental, again, in that margin, you're going to see some flex here. They're going to add more to it because that margin is going to cover all the risk, anything that's on the fringes or all the extras that are involved in your personal situation. Another thing that's going to affect this is the type of property it is, not just the occupancy, but the type. Is it a condo? Is it a single family residence? Is it a townhome? Is it multi-unit? All of those are going to have risk or pricing adjustments when it comes to that margin. Now, some lenders can be really restrictive when it comes to this. So make sure when you're shopping around and talking to lenders that you give them the entire story, the type of property, the occupancy, as well as all the other details that we talked about earlier, so they can give you an accurate quote and make sure that they can lend on your property in the first place. The last thing you want to do is go through this entire process only to find out that because you didn't disclose that you don't actually live in this property, that you can no longer get a HELOC on it. So it's pretty straightforward on how you qualify. Now let's just quickly wrap this up with what could kill the deal. And here are the most common ones, guys. First is having too much revolving debt. I told you earlier that oftentimes they can look at what this new payment is going to be if you are consolidating debt, but if you have way too much revolving debt and the ratios are out of whack, a HELOC lender might consider this to be too risky. So be mindful of that when you're getting your financial house in order and getting ready to apply. Another thing would be unstable income. Now, if you're W-2'd, this is not going to apply, but if you are self-employed and income is all over the place, you should expect that that's going to come into question, and it could ultimately be a deal killer, but it doesn't have to be. And then the last deal killer is an over-leveraged property, or a property that does not have enough equity in it. If you're in a market that has maybe corrected quite a bit, so for example, you put down 20%, but that market has pulled back 5 or 6%, which means you don't have 20% equity in this home. You have something like 14 or 15% equity in this home. And that might be too little to get a HELOC on. Or if you have taken on a large mortgage and maybe you already have an existing HELOC that you were looking to replace with a new one, you could be considered over leveraged and ineligible to qualify for a new one. So in closing, guys, remember that your home creates tremendous opportunity because of all the market forces. And we live in a time period now where home equity is the highest that it's ever been in the United States. And depending on where you are in the United States, it could be even more extreme than that. But at the end of the day, you still have to qualify to use that equity. And above all, very important disclosure, guys, what you use the equity for is so key and so critical. It must be used for something responsible or something that's actually going to better or improve your overall family's financial picture and not be something that's going to add to it in a negative way. Thanks for listening, guys, and we'll catch you on the next topic here for the Mortgage Reports.